You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
Hey folks, welcome back to the Shoe In Show. Thanks for joining us for this week's episode, which we are focusing on the U.S. economy and at a micro level more down to footwear, how it's impacting footwear consumers, footwear companies, and providing some insights into what executives are thinking and seeing that will impact footwear strategies, footwear product development, footwear jobs, capital investments, etc. As we go through things that really, Matt, only FDRA can provide. So maybe tee us up and let's get into it today.
Yeah, it sounds good, Andy. So one of the things that we do, and we've been doing it for several years now, is going out to a large swath of the footwear industry's executive ranks and asking them questions about how they feel about the economy. We call it the Shoe Executive Business Outlook Survey. And to help us kind of unpack the results, we have Gary Rains, our fearless economist, on with us as well. And Gary, out of the gate for the second quarter of 2023, as I read through the results, what I come away with is that continued notion of a glass being half full and half empty. And we use this analogy pretty often, but it seems in today's era of kind of unpacking and deciphering economic data, it's the best way I know how to kind of capture it in a creative sense. So what are like two or three things that have stood out to you as you looked at the data, you started to provide the analysis, and you started to read the results?
Hey, Matt, it really was the case that both the glass half full and half empty metaphor there. Really, there was a little bit of something for everyone in this survey, and you could take it a number of different ways. Talking about a couple key points, we had seen that respondents generally had turned a bit more downbeat on their prospects for both shoe shoppers and the broader economy, as Andy had mentioned. But we also saw maybe glass half full that respondents also said that inventories were much more in check than they were 6 months ago and likely to decline even further over the next 6 months. That suggests that we're likely to see that declines in capital expenditures from what we had witnessed over the last 6 months or so. So it's on the one hand, it's a bit of belt tightening, maybe battening down of the hatches, if you will. But at the same time, coming from where we were just a year or two ago on the backside of the pandemic, with inventories really flush across so much of the economy, not just in shoe stores, but certainly in shoe stores as well, we're seeing those numbers come a bit more in line with long-term trends.
These surveys are interesting. The surveys are interesting from an emotional standpoint, Andy, because I think you can be in a meeting where you literally get an email that your sales are down, and then you walk out and you get online and you fill out the survey and you're downbeat. Or you could be in a meeting where they say, we're finally getting our inventory levels under control and it's softening a little bit, but at least we don't have too much stuff, and you walk out feeling a little bit more upbeat. And so I always think about kind of the human psychology of filling out these surveys, particularly from an outlook perspective, where we're not really looking at hard data on sales numbers, but we're looking at how people feel about their own hard data. And so that's always been an interesting part of the survey for me.
Yeah, I don't think we've had smooth sailing in terms of looking at the micro, kind of look at the shoe industry. We haven't had smooth sailing in years. I mean, even before the pandemic, right? We still had inventory issues. We still had tariff costs that were increasing. It was, back and forth. So, and looking at this, it's not shocking that you have these, this is going really well, and this is not. And I think most people in the industry are positive for the most part. They look at the world with rose-colored glasses. I do oppose your idea that Gary is fearless. He has lots of fears. One of them probably his wife, but in other ways, like I think Gary and I probably also are very fearful of another rate hike that could come. Right. We've already seen how rate hikes have kind of crashed things in different ways that people didn't anticipate. With the banking sector, with credit issues, with things like that. We have other We have the other larger knocks that I think I want to get Gary's opinion on too, and then we can dive back into the micro level. But at the overall economic level, um, we see prices paring down, right? So we see inflation starting to drop back down. It's still quite high. And Gary, I'd like to get your opinion because I think the difficulty is the fact that we still have full employment and likely will remain so because even if they keep going, the rate hikes keep going up, there's still a shortage of workers in the market. So it makes it really difficult because normally we see a rate hike and then we see job losses and that like rebalances the marketplace and the economy. And I feel like there's no rebalance, and I don't know if they're going to keep going higher to do that or not.
Yeah, you really bring up a number of key points there. You both the lagged impact of rate hikes. Looking at what's going on with labor markets. How all these different issues interact. The Federal Reserve has been raising interest rates for about 14 or 15 months now, and it's pretty widely accepted that the full impact of rate hikes don't really manifest themselves in the economy until 12, 15, 18 months after the rate hikes happen. So looking at it that way, we're only now seeing kind of that manifest impact of the first rate hikes only impacting things across the full economy now. Not to mention, as you said, there's likely to be at least one more, maybe two more rate hikes set to come later this year. That's likely to push interest rates to the highest in over 40 years. And of course, it's likely to be, again, another 12 to 18 months before we see that full impact of these presumably forthcoming rate hikes play out across the economy.
See, Matt, I told you, he's very fearful. He's very fearful. We didn't get his wife. We were just talking about the economy.
Yeah.
Talking about
hey Blake, can we make an edit and say our fearful leader, our fearful economist, Gary Rains? Make that edit for me, please.
That's right.
Okay, so we have that happening, right? And we have seen some companies pare down workforce, but I still, and there may still be some folks that there may be some trimming, unfortunately. We never like to see that, but it does happen in business. But I just don't, in this, Gary, what are we calling this? It feels like a recession, like we're in the middle of it. We won't know for a while until somebody looks back and says, yes, that actually was it. But it feels like it, right? And Matt and I talked about this. We've never seen more reports from like stock analysts saying just like missing estimated that, over the next 6 months, sales will continue to stay flat or drop. And then also added to that is the number of emails we're getting from logistics folks trying to get orders, just trying to move product and saying, if you got anything, I can do the shipping, and that just tells you there's a lack of product moving around, both in terms of demand, but also importing in. So you have this, this weird space where we're in the middle of it. And then you look at this outlook survey from our folks, and you clearly see that in the numbers about their outlook for the economy and all that stuff. But then you also see them finding ways to trim still. So as I look at it and I go down into, what they see as landed costs, inflation's coming down, but their operating costs, they have a much better outlook for their operating costs versus 6 months ago. So they may not be selling much of the market, but I feel like where they're leaning into is trimming. Gosh, I don't know if there's any, I don't even want to say fat anymore because people are pretty lean, but they're finding ways to use software better, let's say, to increase productivity. So for me, it's really interesting because you got this weird moment in time where everybody's dealing with it right now, but the outlook of what's coming for their operations is a lot more improved, in my estimation.
You're exactly right on the operating cost. In fact, this latest survey marks the fourth straight quarterly survey that we've seen the share of respondents saying their operating costs versus both 6 months ago and 6 months into the future have declined. For the fourth straight quarter. In fact, those saying operating costs are likely to be increasing over the next 6 months. That share has fallen to its lowest, my goodness, in well over a year. I suspect longer than that. It's estimated now somewhere it's about 38% or so. So yeah, it really goes to your point.
One of the things that is really interesting about the data, Gary, and something we have to kind of coach our members on, is that for the longest time we saw shoe store sales, at least on the government data side, increasing significantly, or maybe not significantly, but increasing. We see kind of an elevated sales, position relative to last year, which was a huge year for us. I think it was $105 billion a year. And now the bottom's almost dropped out. It's almost like this switch has been flipped. Andy referenced the earnings reports that, or at least the guidance that's coming out. And so talk to us about kind of the data lag and when you expect to start to see the data, at least from the U.S. government side, line up with the reality as it relates to where we currently find ourselves in real time for footwear sales.
Yeah, on the one hand, again, glass half full. We've seen that footwear consumption touched a record level last year, well north of $105 billion for the year. But glass half empty, we're seeing, while that trend is continuing so far in 2023, that we're seeing continued year-over-year growth over each of the first 4 months of this year. We're seeing that growth decelerate. In fact, in April, footwear consumption only increased 1.6%. Year over year. That was the slowest in about the last 13 months or so. And we've made the argument for some time that we think that growth is likely to continue to decelerate, not only these last couple of months, but likely to continue weakening over the next couple of months, and may even turn into contractions as we get deeper into the second half of the year. We've also made the case that we think we're likely to see darker economic skies over the second half of the year. And of course, as that sinking tide, tends to lower all ships, I think it's likely to lower that footwear consumption ship along with it.
I'm also looking at like the inventory stuff, and inventory. We can talk about like what's an art, what's a science. But the inventory outlook is that they feel like they're getting their inventories back in working order, where they feel a lot better about getting things in line. And I always think it's a curious question, right? Like you're asking at a point in time, like, what do you think going forward? But I think part of that also is what they're comparing it to on their sales side, right? So they're saying, okay, we're paring back, but we know full well that development, everybody's leaning into development right now, because the best way to move inventory is to bring a new product that's dynamic and interesting and cool. So we know there's a lot of development work coming in. So I kind of look at this, and it's just always curious to me, because you've got this one thing where they're hopeful their inventory levels will stabilize, and then in actuality, when sales start to uptick, I mean, it's human nature to be like, we got to take advantage of this. Like, let's drive more orders, right? So the inventory things are always funny to me, because it just never I don't think we can ever get our hands around where we actually are as an industry on inventory, because it is human nature, right? You see sales go up, you get exuberant, you start putting in a lot of orders, or in this case, you see sales go down, you feel, like you feel a little afraid, and then you start slashing orders. And we saw that, at the start of the year, where some companies were slashing 25% of their orders, maybe a little bit too much depending on product. But I think that's, it's always a curious thing when we're looking at that in our data, when we're just saying, okay, like why did they say that?
I think that's interesting. Yeah, I think that's interesting, Andy, because what's unique about the COVID era is that someone pretty much kind of put a kink in the hose and then unleashed it, and that rush of water flowed in even after our thirst was quenched from a consumer product perspective. And so all that inventory was flowing in even after orders had dried up, and it just piled up. And it'll be really interesting to see, particularly as we are just out of market in New York, and hearing relatively positive things about the desire to start getting back to placing orders to meet fulfillment needs, whatever that level is, to your point, how we come back from that, and how much of what just happened over the last 2 years informed us and altered our behavior on the buying side, because we did get to a point where we just ordered so much. There was so much cash in the system. There was so much demand. We ordered so much it couldn't even get in. And by the time it arrived to our shores, some of it wasn't needed anymore. And so we're trying to have to dispense with it. And so I think that's the human nature side of it. Will be very curious to see kind of how our businesses and our brands develop. Are they wiser on what they purchase? They have better data. How do they understand meeting demand? What do the demand models look like in a post-COVID era? Will it kind of stabilize to norm, kind of what it was in 18 or 19? I don't know, but I think we had such a unique experience. People are going to be probably strategizing in many different ways.
Yeah, Gary, go ahead.
I was going to say, yeah, I agree with Matt. It is, I think, human nature, and we see it played out in the economic data. It's human nature that pendulum tends to swing, overswing too much in one direction, versus the other. And we certainly see that, playing out here on both quantitative data, looking at import data that we saw, of course, record shipments coming into the U.S. last year. And so far this year, even though footwear consumption is still up modestly, we're seeing that footwear imports are off, 29-30% versus the same first quarter of last year. So we're seeing that pendulum. Maybe once it went too far one direction, we're seeing that human nature reaction to maybe overcompensate and swing the pendulum too far in the other direction. And I think it's that lightning strikes twice, over and over and over, seeing it strike again.
Yeah, the one positive is working in footwear is everybody has to have shoes. So I think our issue is they might not be buying multiple pairs like they once were, or they're extending the extra month or two to get more wear out of the footwear. So and that's why when we look at this outlook, we look down at the very bottom. The last kind of thing we look at is what's the biggest issue that you think your company's facing over the next 6 months, and you've got inventory is very high, but the biggest thing is the consumer behavior shifts, and there's continuing fear about understanding the purchasing power, the purchasing patterns, and the purchasing strength of consumers in this marketplace. But it's also weird, Gary, because in a normal recession or a normal tightening, you would see people paring back spending pretty massively. And I think the U.S. consumer is paring back spending strategically, meaning and talking to just different friends in different industries. I have a friend in flooring, and he said, things have kind of dried up in the last 2 months where it hasn't really gotten many calls. And I said, well, it's probably a large expenditure to redo your floors, right? And he's like, exactly right. And so he sees that. I see other things where large appliances, if you can't get good financing, you may put those off for a bit. So larger purchases are kind of on pause, but they're still spending on airline tickets. They're still spending on food and beverage out in restaurants. So it's strategic, right? They still want the experience. They don't want their lives to suck. They still want cool stuff on their feet or on their bodies, but they're basically saying, okay, like my budget's stretched, but I'm not going to I'm tightening. It's like uniquely American. I'm going to tighten down on the big spending, but everything else I'll keep spending, right? I just added Hulu to my Netflix and Amazon, but I'm not going to buy a washer dryer. It's like, all right, well, I don't know how that is sustainable for your finances in the long run, but I think it's uniquely American maybe as we look at the market, and that's why the consumption remains, because it is an expenditure under, and this gets into like economic elasticity, but like under $50 or $100 per pair.
Right. It has been a truly unique business cycle. Of course, the early days of COVID, obviously everything dried up, all the lockdowns. Then we saw all the government stimulus measures, both monetary and physical, dumped on the consumer. The consumer was suddenly flush with other people's money. The consumer began, spending like drunken sailors, which caused the recession in the early days of COVID to be while the sharpest on record, also to be the shortest on record. But coming out of that, it's a bit like I talked earlier about the fool in the shower, going back to quote an economist from a couple decades ago: too much hot water, too much cold, too much hot, too much cold, and you overcompensating in both directions. And of course, then with all that stimulus money floating around, naturally that is inherently inflationary. You began to see the Federal Reserve, clamp down on interest rates. As I said, we're in that phase now for the last 14, 15 months or so, and I'm afraid that we're going to see again too much cold water, that it's going to maybe tamp things down too much as that pendulum overswings in both directions. But it is really a business cycle unlike any that we've seen, and I think all that stimulus money, while a lot of it is still floating around in the economy, that will tend to lengthen the business cycle from its normal kind of sine pattern you might see over the long term. It's going to stretch it out over a longer time period, but ultimately we're going to return to a that sinusoidal business pattern of expansion, contraction, and I think we're more likely to see prospects for a slowdown, even a contraction further ahead, more so than I think upbeat prospects for a continued no landing economy and continued contraction. Continued expansion. I don't think that's likely to be the case. I think it's likely to be more likely of a slowdown and contraction ahead.
All right, so we got fools in the shower. We got drunken sailors. Gary, you're always good for these great analogies. We got buses on hills. We've got half empty, half full. There's just so on one hand and on the other. The Gary Rains isms are phenomenal to help us kind of think through these things critically. I think if folks want to get access to the actual survey itself, there's so much more that we didn't even touch on. You can send us an email at info@fdra.org and put in the subject line survey, and we will email out a link to you. So info@fdra.org, subject line survey.
Awesome. Well, we'll keep looking at the different aspects of the industry and cost and demand, surveying our members and seeing what's happening and trying to report that back, because we do feel like this is a platform that tries to help the industry kind of benchmark themselves and see what's happening and get new ideas. And so we appreciate you listening this week. And as always, tell a colleague, tell a friend, pass this around your organization so people can kind of get a line of sight. I tell people it doesn't matter if you're in sales or marketing or if you're in design and development. These conversations are important to understand situational awareness to our industry and what's happening, and just build knowledge and strengthen the community that we have. So again, appreciate you listening. shoeandshow.com is the full catalog. You can go back and listen to all our other great shows. The next episode will drop Monday morning, as always. Hope you listen to that. And appreciate you guys and the many, many support that you give us over the years. On behalf of Matt and Gary and myself, Shoe-In is out.
Shoe-In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.